What is up, everybody? This is Books of the Stock Market. I hope everyone is doing well. This is the Sunday report where I cover the top articles from Monday through Friday. At the end of each article, I'll be giving my thoughts on how the article could impact or has impacted the financial markets. Without further ado, let's get into this week's Sunday report. On Monday, we saw GameStop rise over 40%. We saw GameStop close the day at $194.50. That's a 41.21% increase and was the highest close since the month of February when the short squeeze occurred. Many people believe this move upwards was caused by the announcement that Chewy co-founder Ryan Cohen will actively transition the gaming company to a more e-commerce focused company. There is still debate whether this was caused by another short squeeze. According to S3 Partners, the short interest on GameStop was $1.9 billion or 25.38% of the stock's float. A week ago, it was 32.56, which is still less than when GME squeezed in February. Therefore, people are skeptical that GME is going through another short squeeze. The other alternative theory analysts are proposing is that people are using their stimulus checks to fund this move. Furthermore, analysts believe the additional $1,400 that is expected to come into people's bank accounts will continue to fuel the run upwards on meme stocks like GME. Personally, I don't think the rise was due to a short squeeze as the data shows much lower short interest when compared to February. Currently, I have no positions in GME, but maybe I'll make a move if I want to lose money again. The CSI 300 index dropped by 2.2% on Monday morning. This is even after China's national team, which is a group of hedge funds backed by the Chinese government, stepped in. Many found it surprising that government-backed hedge funds couldn't stop the drop downwards. However, the intervention allowed the CSI to rise back to being only 2.2% down for the day instead of 3.2% for the day. Many analysts are watching the Communist Party's biggest annual political event that is expected to happen on Thursday. Many are guessing the Chinese government will pull out bullish projections and also reiterate the government will continue to support the economy. It looks like governments all over the world are having trouble stabilizing the markets. With places starting to reopen, inflation will be a problem, and to see that it has already produced negative side effects only seems to foreshadow how worse it can get. On Tuesday, we saw Tesla up almost 20% for the day. Tesla closed the day at $673.58, which is a 19.64% increase. On top of that, it is up another 2.32% after hours. This move was caused by a general recovery in the stock markets. The S&P 500 was up 1.42%, while the Nasdaq 100 recovered by 4.03% after some heavy losses last week. This rise was Tesla's strongest rise ever since February 2020. However, it is still down more than 20% from its high in January. It was also reported that Tesla sold 18,318 China-made vehicles in February, which was an increase from the 15,484 vehicles in January. I chose this article because it represented the Nasdaq recovering from the 10% drop that happened a few sessions ago. This move upwards should continue unless we see some unexpected moves surrounding the $1.9 trillion stimulus bill that is expected to pass on Wednesday. On Tuesday, it was reported that the US government saw the largest two-week decline in gasoline supplies. The shortage in oil was due to Texas freezing a couple weeks before. Furthermore, we saw an increase in the miles driven as states start to reopen. Many analysts further believe the demand for gasoline will increase as most states return to normalcy. However, this is not true for all countries around the world. We saw Europe lagging behind the US in fuel demand because Europe is also lagging behind the US in COVID vaccinations. Furthermore, we saw OPEC Plus last week restrict oil production, which further pushes oil up. Oil was up in the morning but ended the day pretty red. Overall, I agree with the analysts about oil demand increasing as states start to reopen. On top of that, OPEC Plus seems to be limiting the supply of oil, so it's totally possible we see WTI rise further. On Tuesday evening, it was reported that China's factory gate prices rose at the fastest pace since November 2018. The producer price index rose by 1.7%, beating expectations of 1.5%. We saw Beijing overall grow 6% above its growth target for 2021. On the other hand, we saw the consumer price index fall to 0.2%. This means that there is deflation within the consumer market as prices are decreasing. However, many analysts believe this will not last as the producer price index rose. The producer price index rising means that it costs more to make products. This increase in costs will eventually be reflected in price, and therefore we should see a more inflationary environment. So far, I think this article is the most important article as it signals that inflation might be around the corner. If Chinese factories decide to increase the price of their services, then we can see prices of everyday goods start to increase as well. Obviously, this is not good for a recovering economy. On Wednesday, we saw U.S. consumer prices rise by 0.4% in February. This is a 0.1% increase from January. As U.S. consumer prices rise, this can continue to be a worrying trend as this further signals inflation is just around the corner. We saw prices rise the most in the food and energy sectors. Many analysts believe both sectors were affected greatly due to the rise in oil. With oil supply plummeting in the US and OPEC Plus continuing to restrict oil production, we saw the cost of energy go up. Furthermore, food prices also went up due to food being more expensive to manufacture and distribute. Inflation was already expected to happen once countries reopen, but it seems as if oil is accelerating the rate of inflation. So far for this week, we saw signals of inflation occurring around the world. As mentioned before, we saw China factory prices rise and saw data from the US support the inflationary trends that are happening around the world. We saw another inflationary signal come out from Washington on Wednesday. On Wednesday, we saw the $1.9 trillion stimulus plan passed by Joe Biden. In this stimulus plan, we saw $400 billion for the $1,400 stimulus checks and around $350 in aid to state and local governments. The rest of the funds were used to increase vaccine distribution and help fund certain tax credits. This plan was approved by a 220 to a 221 vote where 0 Republicans voted for the bill. Janet Yellen also came out saying this bill will help speed the recovery up. On the other side of the road, we saw the Republicans disagree with the bill as they considered it to be wasteful and full of progressive priorities. It's kind of funny how not a single Republican voted in favor for the stimulus bill when they were all happy to vote for it when Trump was in office. Now with Trump gone, it seems like they're trying to care about the national debt when it was during Trump's administration that we see an exponential growth in our national debt. The S&P 500 and the Nasdaq 100 were up a lot today. The S&P 500 was up 1.04%, while the Nasdaq 100 was up 2.36% for the day. The move upwards was due to the confirmation of the stimulus bill, which means people will be receiving their $1,400 stimulus checks. Furthermore, we saw jobless claims rise less than expected. For the week of March 6, we saw only 712,000 people sign up for jobless benefits, while the estimate was 725,000 people. The decrease in jobless claims further shows the economy is getting back to pre-pandemic times. Putting these two factors together, we saw stocks recover. It looks like stocks are especially liking the stimulus bill passing. With the stimulus bill passing, money will once again be injected into the economy. This means there will probably be inflation as the dollar weakens, which is the ideal scenario for a rising market. In the $1.9 trillion stimulus plan, we saw that student loan forgiveness will be tax-free. This move is pretty progressive when you think about it and is in line with Biden saying he will support the cancellation of $10,000 of student loans. According to experts, this move to push student loan forgiveness as a non-taxable event probably saved $2,000 of taxes if Biden decided to cancel $10,000. If it was for $50,000 of student loans, as many other progressive Democrats are pushing for this amount, then the average borrower would have saved around $10,000. This new rule will last to 2025, but it could be extended or eventually become permanent. Overall, this move proves that Biden was actually sincere about his $10,000 promise. I thought it would be another empty promise made by another politician trying to get elected, but it seems like the Democrats are really pushing for some sort of student loan forgiveness. As for Friday, it was pretty calm as there were no real big stories. However, we did see the dollar rise on Friday after Treasury yields started to increase. Many attribute this rise to U.S. producer prices reporting the largest annual gain in nearly 2.5 years. If you look at the TNX, you can see that we gapped up overnight after testing a very important trendline. This red trendline has been supported by price action dating all the way back to 2 years ago. However, we recently saw a retest of the trendline after breaking out of it and a resumption upwards. This is very bullish price action which further supports yields will continue to rise. Like I said before, the PPI increase in both the US and China shows that price increases will soon trickle down to everyday consumer goods. It should be interesting to see if the economy has recovered enough to handle the inflation that is coming soon. So what are my thoughts on this week? Stocks seem to have recovered and yields have cooled off. The job numbers were better than expected and we saw the stimulus bill finally pass. I guess the only negative part during this week were oil prices rising. However, oil prices rising alone is not enough to stop the economy from recovering. Well, that's it for me. If you like this video, press the like button. If you have any questions, leave a comment below. If you don't want to miss out on any future content, press the subscribe button. Thanks for tuning in, and I'll see everyone next week.